Hey everybody, it's Pete. Welcome to today's episode of Stocks for Breakfast. It is Monday, June 29th, 2020. First, I want to start off by saying I hope everybody is safe. It seems like the news is not getting better, especially where I live down here in Florida. It seems like we are starting to go off the rails with new cases. So I want to start out by saying I hope you're safe. I hope you and your family are doing well. It's trying times for everybody. We have to do our best to get through this and come out the other side. Sometimes we have to have a little discipline, and quarantining is not easy. I work from home on top of quarantine, so it's stressful. But I just hope you're safe. That's really the first thing I wanted to start out with. So today we're going to talk about something that is so fundamental to trading that it shocks me how many people don't understand what I'm about to teach you. And I'll even put it a little further than that. It's literally scary that you don't know what I'm about to show you. And I understand that you might not know it kind of at a professional level, but we're going to talk about today is basic order placing and the differences between a limit order and a market order and how that affects your executions, how that affects how you get in and out of trades. Just knowing what I'm about to show you can make or save you thousands of dollars a year just by routing your orders properly. That's a pretty big buildup, but it's 100% the truth. When I was doing seminars and teaching my class live all over the world in the 2000s, mostly up to 2012, I was shocked at the amount of people that would come up to me during a break when I was teaching the course that the only order type that they used was market orders. That's crazy. That is absolutely crazy. You are getting some really, really bad fills, and you're putting yourself out to the market in a way that you're just basically saying, fill me wherever you fill me out of your order inventory, which is just absolute garbage. You should never do that unless you really need to get out of the stock or really want to get into the stock very quickly. So there's two different scenarios. You really want to get in quickly and you really want to get out quickly. But hopefully if you do a good job, like we teach in the boot camp, hopefully you do a good job of understanding order flow and understand how to read the tape. You'll understand when momentum is slowing down. You'll understand when stock prices are kind of potentially reversing, which we call exhaustion or accumulation or distribution. Specifically exhaustion. Accumulation or distribution happens over time. It happens over days, weeks, and months. But exhaustion can happen like that. So what we're going to cover today is the type of order, and I'm guarantee you, especially if most of you are retail traders who don't really think about this stuff, what you're about to learn can save you thousands and thousands of dollars just based on how you place your order, which this also highlights the fact of why I generally trade liquid stocks, which means that there's typically a lot of smart money or institutional activity at every price level. Now, I want to make clear, I always talk about that. There's two reasons for liquidity. There's number one is the downside, which is what we're about to discuss today, or managing or being relatively confident you're going to be able to get a fill where you want to get a fill. So in other words, you place an order, you're probably going to get that price because there's people at many levels. The other part of the equation is that typically liquidity means that the stock is in play consistently. So those are the kind of stocks that actually make it all the way into my trading universe, where I have this list of 20 to 25 to 40 stocks that I scan for every day. So when I say scan, I'm talking about I'm scanning to read the tape to see if there's opportunities. And then we have separate scanners for stocks that meet the criteria that I don't trade every day, but maybe they'll work my way into the universe and I'll start trading them a little bit. So anyway, what we're going to go over to, I have this spreadsheet built out. Don't worry, there's no math involved here at all. It's just price quotes. And I promise you, a lot of people are not going to know what I'm about to teach you, and you'll be shocked, literally shocked at how simple order placing can be and how lazy most traders are, where they're just marketing in and marketing out, and it's costing you a small fortune. Trust me. So we're going to talk about buying stock as the number one criteria. So we're going to basically walk through a simple trade where, let's say you bought a stock here. You bought it at $50. Now, something I want to bring out here too is you don't need to know, you don't need a level 2 quote for this, but it's certainly would show you this in real time and the depth behind the order. So what generally happens, and you might have seen this, some software like TradeStation and other ones where there's bids on one side, there's offers on the other side, but most people don't even understand the power of actually having those bids and offers there. So if you're new to trading, the bid side is where people are advertising to buy the stock. So let's say, for argument's sake, right now, the best bid is $50.24. That's the highest price people are advertising to buy. And then there's other prices below that where people are advertising to buy. The ask, which is also known as the offer, so it's usually the bid ask, but some people know it as the offer. This is where people are advertising to sell stock. So these are limit orders, by the way. This is a limit order to buy it at 50.24, 50.23, and so on and so on. And also within these bids and within the offers, then you also have, and I'll just throw a number out there, you also have the amount of shares being advertised at that price. Okay, so we'll just leave it simple like that, right? So then the ask side is where people are advertising to sell. So you have 26, 27, 28, all the way up. Right now, here's where people make a mistake. And this is the most expensive mistake you could possibly make. Let's say that you bought the stock at $50.25 and the stock starts to go up, just for argument's sake. You could place a limit order up here at 50.55. So limit order at 50.55. And if the stock trades all the way up to that price, you're advertising to get out of the stock at that price. So it travels up there and momentum travels up, buying, and you get out at 50.55. Here's where people make the mistake. If the stock you bought at 50.25 and it starts to go down, they usually use a market order at a certain price. So in other words, they'll mark it out and it doesn't matter the price, or they use a stop market, which is also a limit order. So it's a stop order on quote. So in other words, you long the stock or you bought the stock at 50.25 and you say, okay, I want to place a stop loss order at 50.24, market me out of the order. That means that when it goes down to that price, you'll get filled at any available price on that destination that you sent the order. Now here's the most shocking part. You can get filled anywhere. I don't want to get into too much of the specifics here, but let's just say you bought the stock and it starts going down, you mark it out, you can get filled at any one of these prices because you're not putting in a specific price. Here's the shocking part, okay? And this is going to be a real revelation for most people. Let's say, for argument's sake, the stock is going down really fast and I want to get out. You mark it out and you get filled wherever. I could mark it out of the stock, I could place a trade to sell the stock at 50, which clearly is 24 cents below the best advertised bid. But this is where trading, and you can save all this money, comes in. And I'm just going to type this in live so that we can all understand this together. So price improvement. If this stock is going down and I place an order to sell the stock at 50, I will get price improved up to the best available price. So that means I could place a sell limit order at 50, and if there's shares available at 50.23, I'm going to get 50.23, but I'll never get worse than my order. A market order will get any price because you're not putting in a limit order. I'm placing a limit to sell at $50, and because of price improvement, because I placed a limit order, I can't get worse than 50, but I will get always price improved up to where their stock advertised to buy. So this is where most traders just lose thousands and thousands of dollars every month because they're marketing in, marketing out, marketing in, marketing out, and not trying to use a limit order, which is just crazy because I just literally showed you I could place a order to sell, a limit order to sell way below the market, provided your stock has liquidity, which obviously most of the stocks I trade do. You will get price improved up to the best advertised bid. A limit order means at that price or better. So if I place an order to sell at 50 in this example, and there's advertisements to buy at 50.24, I'll get 50.24, and so will you. It's not revolutionary. It's the way orders work. That's the definition of limit order. Now we're going to use the same thing on the other side about how to get into a trade that you really want to get into that's moving fast, but you don't want to get a super bad price, which is what most people do when they place market orders to get in or get out of a trade. But this time we're actually going to talk about getting into a trade. So we're going to go over and share the screen again and do the same thing on the opposite side. So let's say, for argument's sake, right now, the stock is bid at 50.24. So it's 50.24 by 50.26. But all of a sudden, you start to see the stock jumping. It's like exploding to the upside. Maybe it just broke out of a really obvious level. Maybe in our world, it peaked above the opening price, or maybe the SPY just exploded, and then your stock is starting to bounce a couple of seconds later. Now, what a lot of people will do is they'll place a market order because they see the thing sprinting. They place a market order to buy, and they'll get filled. This is the bid price now, and they'll get filled anywhere that order gets filled, which is going to be tough because tough to get a good fill because now it's moving fast. People are pulling their offers. A lot of other people are trying to get in at the same time. So you'll literally get filled anywhere there's stock available and at any price on the route that you place the order. Now, here's the opposite of what I just said about selling, and this is where routing your orders becomes super advanced, and like you really know what you're doing when you can do this, and it's not complicated. If I place, let's say it's running up, and I say, well, I like it, but I don't want to pay too much for it. I don't want to get hosed and get 50 cents above the market because I place a market order, and then immediately I'm down a lot of money on the trade. If I place a order to buy all the way up here at 50.33, and you place a market order, you can get any price, right? If I place a buy limit order, or I'm not just saying me, it's nothing special that I can do. This is the way orders work. If I place a buy limit order while this stock is rocketing up to the upside, and I decide that 50.33 is the highest price I'm willing to get, if I place an order to buy at 50.33 and there's shares available at a better price, I will get filled at whatever the best price is, but not worse than that price. So I could place this buy order while the stock's going up at 50, or I keep saying me, any one of us can do this as long as you use a limit order and there's shares available, which is why I keep touting liquid stocks that have a lot of liquidity or trade at average volume. If I place or you place an order to buy the stock at 50.33, we could technically get filled at 50.27, let's say, all the way down here. Technically it's here because there's shares between there. So it's 50.33 buy limit order, which means we can get no worse than that price. So we can't get 50.34. We can't get worse than this price, but we can get better. The only downside is if the stock is moving really fast with the limit order, you might not get into the trade or out of the trade with the limit order. But again, if you're good at reading the tape, like we teach in the boot camp, you'll be doing this at a time where it's not a shock. The terminology we use all day is anticipate, 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 anticipate. Most traders get crappy fills for one of two reasons. They don't understand what we're teaching right now, or they're not anticipating where they want to enter, and the stock has already moved against them at the price that they would really like to have gotten filled. So again, I just want to cover this as a recap really quickly. If this is where the stock is right now and you bought it, and if I place an order to sell this, a limit order to sell the stock at 50, I can get price improved all the way up to wherever stock is available, but I can't get worse than that price. If this stock is moving really quickly to the upside and I want to get in, if I place a buy limit order here at 50.33, I can't get worse than that price, but I can get better than that price. So if this is new to you, watch the video once or twice and take notes, because this is an absolute must know if you have a trading account and you're actively trading. To not know this is sacrilege. It's like not knowing whether you should use a hammer or a saw. It's literally that important for you to understand the difference between market order and limit order, and how price improvement works to get you better executions if there's liquidity on the price that on the route where you're placing the orders. So you might have to watch this once or twice, maybe twice at the very most, because it's really not that complicated. You're really just understanding now the difference between a market order and a limit order, when you should use the two, and how to use it in faster moving stocks to get in or out of a trade where you can get that price but not worse, or that price but not worse when you look to buy a stock. So This is a very important thing, and this is really what separates somebody who's really taking trading seriously from somebody who just can't figure out why they're not making money. This is thousands of dollars slipping out of your pocket just by placing orders correctly. If you find these videos helpful, absolutely click down and subscribe. That would mean the world to me. And if you want to learn more about trading with me personally and see my real-time trades for the next 30 days, click down and learn more about the bootcamp and see how other traders are doing. Hope this helps you. Have a great day, everybody. I'll speak to you soon.